When the shorts begin to cover, okay, it is going to drive the prices to the moon, and those that are short, because nobody's going to sell long. They're going to sell long contracts. They're going to be buying into a vacuum because everybody that's long silver or gold in the futures markets is waiting for the day that we were waiting for in the physical market. We want the price at 3 digits. So they're going to find themselves in a position where they're going to be bankrupt in a matter of days, if not hours. And the whole financial system is at stake here. There's no way to sugarcoat this. The major bullion banks, whether it be Wells Fargo or Citigroup or Barclays or HSBC or the Bank of Montreal or Australia's Macquarie Bank, it doesn't matter. They're all going to be faced with catastrophic losses on their short position. So this is a financial crisis when this thing does finally end. So like I said, they've got to the end game now, and right now they're just desperately trying to prevent this thing from getting out of control to the upside, because when it goes, it's going to bring financial ruin on a lot of people.
You're watching CapitalCosm. My name is Danny. It is November 11th, 2025. And my guest today is a big name in the precious metal space. It's Ed Steer. Ed Steer, thank you so much for coming on, my friend.
Always my pleasure, Danny.
Yeah, let's dive right into it. I think what's on everyone's mind is, have the metals bottomed? Now, again, it is November 11th. Yesterday was the 10th. We did see a big rally in gold and silver yesterday. One of the bigger candlesticks that I've seen lately. And, we're above 4,000 when it comes to gold. We're above $50 when it comes to silver. What do you think here, Ed? What's the latest on the metals?
I'll tell you what, in my Saturday column, I suggested just looking at the chart patterns that the commercial traders and their engineered price decline had done pretty much all the damage they were going to do, and hopefully it was going to rally from there. But even the Monday rally surprised me. It was huge in both silver and gold. And the thing I noted in my column this morning was that it's the first day that I can remember, and I've been in this market now for 27 years. It's the first day I can remember we had an updated gold of over $100, a 3-digit gain in gold, and the first time we've ever had a $2 gain in silver. That was the most eye-opening thing about yesterday's rally. And the other thing was the fact that the volumes, despite the fact that it was monster updates, the volumes in both silver and gold were exceedingly light, relatively speaking. So this wasn't a mad panic by everybody to jump in and make, and drive the prices high. It was a very quiet rally and very well behaved. But if you look at the chart pattern, you can see that the powers that be, the boys, the large shorts came in and tapped it lower a couple of times to make sure that neither gold, silver, or platinum or palladium, for that matter, really got up ahead of steam where they're going to gain like $200 or $300 or $400, or heaven forbid, we see a short covering rally of monster proportion, because the moment that happens, then the jig is up. That's one of the reasons why we saw the price get capped back on October 17th, the Friday, because the prices were heading up and going almost straight up, almost no ask prices. And if they'd allowed that to continue, we would have had the long-awaited for a 3-digit silver price that everybody's waiting for, and that would have happened by the COMEX close in that day. So that's one of the reasons why they stepped in when they did and hammered the price lower just to take the froth out of the market. But I would suspect, getting back to your original question, Danny, is that, after yesterday's big move and what we've seen so far today, that, this wash, rinse, and spin cycle engineered price decline is pretty much in the rear view mirror now, and it's just a matter of seeing how much it will be allowed to rise from here. But I'm very optimistic and very positive on precious metal prices going forward from here until as far as the eye can see.
So back a couple of weeks ago, when we were at the heart of the big breakouts, to $55, $54 silver, $4,400 gold. You saw this episode of backwardation in the silver price. And that gap is largely closed between the spot price and the futures price. Uh, are there any indications from what you're seeing that we could see another round of backwardation? And how did the LBMA close that gap? I mean, do you have any insight on that as well? Did they lease the silver from someone? How did they fill up the coffers with silver so quickly?
Okay, well, this has been discussed quite a bit. The backwardation was like over $2 at one time when,
Hmm.
people, when the people just they said, I want the silver now. I don't want to wait until December to get it. Just give me my silver now. And so we had backwardation below to $2.50 or $2.60. It was incredible to watch, and the LBMA, of course, was in a situation where it couldn't meet deliveries. And so everybody on planet Earth got to see the fact that there was no free float in London, which is the big physical market. So, the cupboards were bare there. And so the call went out for help to the LBMAs specifically. And I have the numbers right here from October. And in October, just a month just passed, there were 58.293 million ounces of silver shipped from the COMEX in New York to the LBMA, most likely to the LBMA in London. And there was about 8 million contributed from the Shanghai Futures Exchange. And the only number that I don't know yet, and I'm still waiting for, is Switzerland. Now, Switzerland is a big exporter of silver. As a matter of fact, they've been a net exporter of silver since 2013. And I suspect that maybe they contributed some as well. But, they put out the inventory fire by borrowing or leasing, or I don't know if they leased it or just bought it or transferred. I don't know what the story is on that. But there was, the call went out, and the silver was on an airplane to London, and the fire is out. You were talking about backwardation being gone now. I checked it this morning, just about an hour ago, and I saw it was about 7.5 cents, which is nothing. We're only today's the 11th, as you
Hmm.
stated at the top of the show. We're only 3 weeks away from the big December delivery month, so the backwardation doesn't really mean a lot. But could it return someday? You betcha. I mean, everybody and his dog out there that follows the silver market knows that we've been in a structural supply-demand deficit for 5 years, coming on 6. And it's anywhere between the Silver Institute says anywhere between 125 and 200 million ounces a year, and this has been going on for 5 years. I mean, how long can this go along before we run out of this stuff? And we got the first, foreshock of what's going to come one of these days when the LBMA was run dry, last month. So, it's just a matter of time before, the demand can only be what is supplied by the mines, and that's about 820 million ounces a year. And, as I said in my Saturday column, when that day arrives, the 2-digit silver price will be history. And then it's only a matter of what the 3-digit silver price is going to be. But it's going to be a very, very impressive number.
Now in 2021, in early 2021, you'll recall we had that's quasi silver squeeze. There was an episode of that back then. And at the same time, there's this report out that accounting errors caused the LBMA to overstate silver holdings by 3,300 tons during that time, during that particular silver squeeze event in 2021. Could it also be that the LBMA is just messing with their accounting as well? I mean, could they? I mean, they've done it before.
I'll tell you what, Danny. Silver analyst Ted Butler, who I worked closely with for the last 15 or so years before he passed, you know, said the LBMA is virtually totally opaque to what's going on. I mean, they don't tell you anything more than they absolutely have to. So when you're looking at their silver inventories or whatever the heck they got, or they say they got, really, you really can't believe it. And they could make up any story about why an accounting error or whatever.
Right.
3,300 tons. I mean,
An
that's
accounting
pretty.
error.
That's like an accounting. Excuse me, I have real trouble with that. So, when it comes to when somebody says, this about London or that about London, I don't have a tendency to spend too much time on it, except this obvious thing where they ran the well dry in October. That was important. Now, that was, like I said, a real foreshock of what's going to come, because the silver deficit is going to eat us alive. And what happened was, back then, is we had a short covering rally where those short, said, I got to get out of my short position. And so they started buying long positions, which drove the price to the moon. And of course, the big commercial shorts, they said, we know that we don't want the price, at $100 an ounce or whatever. So they stepped in and, as what Ted Butler called them, short sellers of last resort, or not-for-profit sellers. And that's what they were, and they killed the rally, just like they did back on October the 17th. It's the same old, same old. But, this one only lasted, 2 or 3 weeks, and we're already back in the uptrend again. And so as far as London is concerned, what we're seeing now, it's somewhat the same, but this is 4 years later. We're 4 years further into a structural deficit. And this was the first sign that a structural deficit is what drove the price higher. And it's just a matter of time before we get the next one.
So my good friend Bill Holter, he talks about this scenario that could arise at some point. It's a very real scenario, and that is what happens when there's a failure to deliver. Let's say that what happens when there's a failure to deliver on silver. What are some of the downstream effects of that, aside from, skyrocketing silver prices? But will will a failure to deliver in the silver market have any downstream effects on gold, on the other paper markets as well? That the rest of the commodities are derived. The rest of the commodity prices are derived from. Similarly, uh, how do you see that? First of all, what's the probability of something like that happening? A failure to deliver on silver. Number two, if it were to occur, what does that mean for not just the silver market, but the rest of the metals and commodities markets as well?
Well, you're talking about contagion, okay?
Hmm.
Where one product will set off another. You have to remember something: is that those commercial traders, bullion banks, investment houses, hedge funds, whatever, that are mega short silver, are also mega short gold. They're short platinum. They're short palladium. They're short crude oil. They're short all the commodities. Okay, so when one goes, it's going to spill over into the others right away, like you saw it in silver and gold and platinum and palladium. I mean, those are
Hmm.
the four precious metals, and it's only a matter of time before it spills into copper, where they have a huge short position. So, it's once this fire is lit. Ted Butler called it the bonfire of the silver shorts. Now, he
Hmm.
only talking about silver. So, we're focused on that, but they're all connected. Okay, they don't have the same production profile, or use profile. The supply demand fundamentals are different both, but it doesn't matter. This short position in the precious metals has existed for 50 plus years now. And when one goes, they're all going to go. And the problem here, Danny, is the fact that when they started this idea of, when they took us off the gold exchange standard back in August of 71, is they came up with this bright idea after 2 or 3 years. We got to stop people from running to gold or any hard commodities into, we want to keep them on the paper side of the street, in stocks, bonds, the currencies, et cetera, et cetera. So they hatched this elaborate scheme to have everybody, to control the paper price, the price of the precious metals or any other commodity through the paper market and the COMEX futures market, which is where the prices of them all are set. So this was a wonderful idea. So away we went on this fiat currency system that we've been on for the last 50 plus years. But they never gave any thought at the time to how this was going to end. Okay? Fiat currency systems, as everybody knows, have never stood the test of time, and all we have to look at Weimar Germany or Zimbabwe or Venezuela or Argentina or whatever, pick a country, to know how they end up. They end up in hyperinflation. So here we are 50 plus years down the road, and we are facing that very scenario where the world is a total fiat currency system. The economies are going in the toilet. Nobody buys the currency, the fiat currency anymore. The thin edge of the wedge of precious metals getting thicker and thicker. And how this is going to end now is something that's staring him in the face. And I can't begin to tell you how serious this is, because when this thing does go and the shorts, this Ted's, bonfire of the silver shorts, it could be the gold shorts, platinum, palladium, crude oil, copper, doesn't matter. When the shorts begin to cover, okay, it is going to drive the prices to the moon, and those that are short, because nobody's going to sell long contracts. They're going to be buying into a vacuum, because everybody that's long silver or gold in the futures markets is waiting for the day that we were waiting for in the physical market. We want the price at 3 digits. So they're going to find themselves in a position where they're going to be bankrupt in a matter of days, if not hours. And the whole financial system is at stake here. There's no way to sugarcoat this. The major bullion banks, whether it be Wells Fargo or Citigroup or Barclays or HSBC or the Bank of Montreal or Australia's Macquarie Bank, it doesn't matter. They're all going to be faced with catastrophic losses on their short position. So this is a financial crisis when this thing does finally end. So like I said, they've got to the end game now, and right now they're just desperately trying to prevent this thing from getting out of control to the upside, because when it goes, it's going to bring financial ruin on a lot of people.
Could they put the kibosh on it by doing something similar to what they did to nickel back in 2022?
No, and the reason for that is very simple. First of all, nickel is a very dinky little market. And what they did in the LME, and you're absolutely right, is they went in there and they just canceled all the trades. I'm sorry that the money that you thought you were going to make on your long position, you didn't make it, and it saved the shorts. You have to understand and Ted pointed this out years ago. He says the total purpose of the Chicago Mercantile Exchange is to protect the shorts. So if they try to do that, the problem with it is that silver and gold are a much bigger market. They're a universal market. They're hardwired into everybody's DNA on planet Earth that they are money and they are of value. So you go into the precious metals market, which is fantastically larger than the nickel market, and try that trick there. Well, good luck to you, okay? That's going to signal right away, okay, that there's big trouble in River City. And, everybody's been touting silver and gold for the last 25 years, and you can see that when the price took off, there were lineups around the block to buy the stuff. Well, if they try to pull off that stunt in the gold and silver market, then the lineups are going to go through the roof, and all they're going to do is exacerbate the situation. And if you're looking for what I think they're going to do and how they're going to get out of it, there's only one way for them to get out of this, and that is to close the COMEX futures market and to close the LBMA. That will prevent all the longs from getting their hard-earned gains and what they've been waiting for years and years. But it will save the shorts, and I'm talking about the big banks, the too big to fail banks, because we could be looking at margin calls of like hundreds and hundreds, like 500, 600, 800 billion, even $1 trillion, because the short position. And this short position could, we could be at $100 tomorrow if the commercial traders put their hands in their pockets and didn't sell short in the market right now. That's what would happen. And the only way they can say they'll be able to save them is to close the COMEX and the LBMA. And then what would happen then is that the pricing of the precious metals would end up in Shanghai, which is where it really belongs anyway.
All right, quick break here, because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, No middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Click on the link down below in the description box and use promo code COSM10. Now let's get back to the video. Yeah, I was going to say, I mean, it becomes a national security issue at that point because of the volume of shorts embedded within all of these too big to fail banks that they would have no choice but to shut down the markets to do so. So then what would happen to what would be the pricing mechanism for gold and silver at that point? Like if you're a gold and silver stacker and they shut down the COMEX or something and you want to sell your gold or you want to sell your silver, I mean, what do you do at that point? Or if you or if you want to buy more, like how do they deal with it?
Okay, first of all, it would be unobtainable. That's the first thing. And I want to go back to for your first point you made. It would be a national security issue. Forget national security. It would be a Western globalist financial power elite problem that would extend from the United States to Canada, Australia, basically the British Commonwealth countries, and Europe. Because the British banks are short, Deutsche Bank is short, PNB Paribas is short. So it would be a Western international globalist problem for them. And they would do it to save their own skins. And the second part of the question is, what would happen after that to save them? What would happen? First of all, I think that almost immediately overnight, you would see whatever silver and gold is available in the retail market vanish. Okay, I mean, we've seen signs of that already. The mints are already miles behind because of the big price run-up we've had in the last 3 or 4 months. And as I and others have said, one of these days, silver and gold and any precious metal is going to be unobtainium.
Yeah, yeah. And you tie this in with what we're seeing here with this battle over interest rates. President Trump obviously wants lower interest rates. There was a little pushback from the Fed up until about a month ago, and they seem to be moving in tandem now. But if you look at history, higher interest rates are not bearish for gold and silver. Actually, point of fact, when interest rates were rising all the way up until 1981, vis-a-vis Paul Volcker, that's when you had your biggest rallies in gold and silver. And it wasn't until 1981 to about 2022, since we've been in a decreasing interest rate environment, the 10-year has broken out of that downtrend since 2022. And ever since then, gold has been on the rise, making new all-time highs, and silver is not that far off from it as well. And so it kind of begs the question, given historical context and the fact that we are in this, there is this remonetization thesis and debt monetization thesis, and gold and silver play a heavy role in that. I mean, can they afford to bring down interest rates, or does history dictate that they will actually increase interest rates?
Well, here's the thing. I remember 1980 all too well because I lived through it. Okay. And I was caught up in when the Hunt brothers, ran the silver price up, and I made a bunch of money in that, lost a bunch of money in that. And so I remember it all too well. And when interest rates went up, it doesn't matter what an interest rate show is a loss of confidence. Okay. We're seeing the 10-year starting to rise now. It's been rising for the last 2 or 3 weeks quietly, but it's certainly been heading higher. So this is loss of confidence. People they do not want to invest in the paper market. Now you take, or bonds or stocks, or basically bonds or in currencies. Now in 1980, we just been off the gold exchange standard for 9 years. And I remember that all too well too. But since then, the debt has got so large and so huge. Everybody knows it's not going to be repaid. Everybody knows it's going to have to either be defaulted on, or it's going to have to be inflated away or hyperinflated away. And we know they're not going to default on it, so they're going to print, print, print. And that's already in the cards, and lower interest rates are just going to drive more and more people into the precious metals, because it's just going to debase the currency. And of course, the US dollar, which is the world's reserve currency at the moment, is going to be hit with the biggest blow of all. But whether interest rates are falling, and if they start rising right now, like they are in the 30-year or in the 10-year now in the U.S. Treasury, they're already rising in Japan, big time. They're rising everywhere. The gilts in Britain, everybody can see. Anybody that's in the know and knows how these money markets work is that this is a lack of confidence in paper currencies, which is the reason why we've seen gold and silver take off. This correction we had on October the 17th, and we had another one like that back in April. I mean, these are just blips, okay? I mean, we're going far, far higher in the precious metals, and they say there may not be another interest rate cut in December. We don't know, but the fact of the matter is that the Fed has already signaled to the market that they're stopping quantitative tightening as of January, which means that they're going to go back to money printing, because they've got no choice now. Absolutely have no choice, because the debt has now run away on them. It's what, 38 trillion in the U.S., and it's just as bad. I mean, I'd take a look at my own country here, Canada. We're what, $1.4 trillion in debt. I mean, I could never have dreamt of that, 20 years ago, but now here we are, and it's the same everywhere. Now we see the absolute panic of people, fleeing the currencies, all of them, okay, and heading into anything, the hard assets, with precious metals being at the top of the list. I mean, take a look at what Morgan Stanley did. Was it 2 months ago or last month? They changed their allocation from 60% stocks to 60-40 to 60-20-20, where 20% is gold. Ray Dalio came out and said you should have at least 20 to 25% of your portfolio in gold. And even Jamie Dimon, of all people, he damned it with faint praise, saying, it's something you should own, whether you hold your nose and buy it. When Jamie Dimon, Morgan Stanley, and Ray Dalio are saying it in the public domain that you should be buying gold, and it should be at least 25% of your portfolio, you should run screaming and sell every piece of fiat currency you got, and every stock you got, and every bond you got, and be buying the stuff hand over fist, because, let's face it, within our lifetimes, we're going to see the fiat currency system that, we've lived in all our lives disappear up in smoke, and it's going to be a worldwide Zimbabwe, and only those with the precious metals in hand, okay, are going to survive it. It's just, I can't believe that the banking system has allowed this to happen. But once you have a fiat currency system, then that's always the result. And gold and silver will be the saviors for everybody. And unfortunately, there's not enough room for everybody on that boat.
Yeah, with the fiat currencies, it's a race down to zero. Some take longer to get there than others, but that's the inevitable endpoint. And let's go ahead and move over to some of the more speculative parts of the precious metals trade. And I'm talking about gold and silver equities and mining stocks. Now, a lot of these gold mining stocks have like all-in sustaining costs of $1,500. Gold is obviously well above that at $4,000. I mean, how do you see these valuations in these gold and silver stocks currently at present?
Okay, first of all, full disclosure, I'm 100% invested in the precious metals and have been for the last 10, 15 years. I remember buying First Majestic Silver, Pan American Silver, Wheaton Precious Metals, which used to be called Silver Wheaton back in 2004 when it first came out for about $1. So I've been all in this thing for a long time. The precious metal shares are wildly underowned. They should be selling for far more than they are now. And not only I'm saying this, a lot of your other guests and everybody else out there knows perfectly well they're not selling for anywhere near what they should be. And it's only a matter of time before John Q. Public finally decides they're going to pile on. We've seen signs of that, in the physical market. The strains on the physical market, the retail level and the wholesale level are pretty immense right now.
Mm-hmm.
So, the demand is there for the physical, but they haven't got into the shares yet, and the institutions haven't got into them at all. So once you see the big institutions, led by Morgan Stanley and people like that, once they start getting on board, then we're going to see valuations start to improve in the gold stocks. And you can see already, I mean, my portfolio is up at least 100% this year, and most people's are. So, they can see the results of that. And, this is just the beginning. I mean, if somebody asked me what inning we're in, maybe the second.
Wow.
So we've got a long way to go. And as far as people that are, listening to this podcast that have never bought precious metal equity before, I recommend a good mutual fund like SILJ or GDXJ for gold stocks, and the first one for silver. And there's very few there's the VanEck Gold Fund and things like that for the larger producers. But do not try to rifle shoot this sector by buying individual stocks. But even the small juniors right now, and the exploration companies are on fire pretty much. They're up 100% or more. So this is a market that's got a very, very long way to go, and it's not too late to get in. Trust me.
Wow, fascinating. I don't know. I mean, I knew you're pretty heavily allocated into the PMs, but I didn't know you were 100%
No,
allocated.
I've been 100%. I don't have a single solitary share in anything else in cryptos. I don't have any of the Nasdaq stocks. It's all wall-to-wall precious metals.
Gotcha. Well, this has been a fascinating discussion, as it always is, Ed. Anything else you'd like to talk about before we close things out here?
Yeah, just one more thing. I just took the stats off the Wall Street Journal's website just now. It's the
Sure.
short position in SLV. Okay, last short report 2 weeks ago, there were 85 million shares, 83 million shares of SLV sold short that had no silver backing them at all. Okay, what happens is that the authorized participants, when the price gets run up like it's been run up in the last 3 or 4 months, starting in August or July, more and more people buy SLV shares, and it's required by the prospectus of SLV that shares be or silver to be deposited to back all those shares. That's a requirement of their prospectus. And if they don't have the silver to back it, then they short the shares in lieu of that. So what the authorized participants are, like the JP Morgans and HSBC and Citigroup and all these guys, the big bullion banks, what they do is they short the shares in lieu of depositing the metals. So there's 2 weeks ago, there's 83 million shares of SLV that weren't covered, that had no silver backing them at all. And the new short report came out, and it's down to 56 million. That's like almost 11% of all the SLV shares out there have no silver backing them at all, as their prospectus requires. So I consider SLV to be a fraud. I don't own it and never will. But if just imagine this, Danny, for a second. If the custodian of SLV, which happens to be BlackRock, and JP Morgan, I think JP Morgan is a custodian and BlackRock owns it, like something like that. But let's say they decided that say, okay, fine, you've got to deposit the silver to back all these shorted shares. Just where is the 57 million ounces of silver going to come from to back those shares? The fact of the matter is, looking at the LBMA going to zero last month, the physical silver just does not exist to back any of these shorted shares on SLV. We're running on empty right now. And any big supply shock or any big demand shock is going to put the LBMA back in the same position. So, we're just sitting here waiting for this whole thing to end, and the deficit will end at one way or another. And at that point, we're going to see an outbreak of Ted's bonfire of the silver shorts. And as I said in my Saturday column, when that happens, like it came close to happening on October the 17th, where things started getting a little parabolic, it'll be interesting to see what the powers that be do in reaction to that. Are they going to let the thing melt up and themselves melt down? What are they going to do? It's going to be very interesting next 6 months, I can tell you that.
It's very interesting you bring up SLV and the fact that JP Morgan is the custodian of SLV. How do you kind of square the circle of Jamie Dimon, the CEO of JP Morgan, kind of banging the drums on the gold and silver trade? I mean, does he, I mean, it sounds like he would be disincentivized into promoting gold and silver if he was the custodian of SLV. If there was a
And
shortage
not,
in price, yeah,
yeah,
go
not
ahead.
only is he the custodian of SLV, but they're also the custodian for ZKB, which is Zürcher Kantonal Bank, which is the largest
Hmm.
gold and silver ETF in Europe. Okay, so they manage that fund too. But how you square the circle on this, we're seeing a lot of the big banks like Morgan Stanley came out. It is so obvious now that their clients are saying, look, if you take a look at the charts, the biggest four biggest movers this year so far, the biggest gainers are gold, silver, platinum, and palladium. And their
Hmm.
customers are asking them, say, look, and of course, these guys are discouraging them from going into this. Oh, it's volatile and da 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 and rah 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 rah. The usual snake oil sold out of a covered wagon they hand out. The thing is is that it's so obvious now that they have to come out. It's sort of mea culpa. They say, no, this is, we're going to come. We have to recommend it now just to cover our ass. That's basically what it is. They can't be seen, fighting this thing all the way up. Sooner or later, they got to throw in the towel. And we've seen three or four major investment firms and individuals and banks finally throw in the towel. So okay, fine. I guess maybe if you really have to, you should invest in gold. And notice they don't mention silver,
Yeah,
just
that is
gold.
true.
Okay, okay.
Yep.
There's a good reason. Okay, but it doesn't matter. Once you light the fuse on gold, the fuse on silver, platinum, palladium, and the rest of the commodities are going to be lit. So it's like this is the thin edge of the wedge, and it just got a lot thicker in the last 4 months.
Yep, totally agree. Well, Ed, thank you so much for your time, my good friend. Where can people find you if they want to see more of your work?
I think just Google my name, Ed Steer, Steer, Ed Steer Gold and Silver, and my website will pop up. And there's a tab on there where you can read a free sample column, and it gives you an idea of what I write about. And I write 260 columns a year, and the cost is US $100, which isn't a lot.
All right. Well, we appreciate your time, Ed. We also have the links to your website down below so people can just easily find it in the description box. So check it out, guys, if you're interested. And guys, if you got value out of this podcast, drop us a like and comment. Go, Ed, go in the comment section. And by liking, subscribing, commenting, and doing all the YouTube stuff, you help in pushing this video and this channel and the algorithms. So it may not seem like much, but a little bit does go a long way, and it's free. And if you'd like to support the channel monetarily, consider becoming a member at the Bullion Standard Pro and unlock wholesale at cost pricing on all of your gold and silver needs. It's 35 bucks a month, but with the promo code COSM10, COSM10 at checkout, you get 10% off your first month. And be sure to click on the special link in the description as well as the pinned comment to unlock that deal. So that's all I got for you today, guys. Thanks for watching. I'll catch you later. Bye.